Good morning and welcome to Stefanutti Stock's financial results webcast for the 6 months ended 31st August 2023. This presentation will be available on our website later today. I will start with an update on the two Kusile power projects, followed by the operational overview. Yolanda will then present the financials, after which I will then discuss industry-related matters and close with our strategic objectives. There will be an opportunity at the end of the presentation for any questions. SSBR Joint Venture Package 16 update. The JV was granted access and have mobilized the HVAC subcontractor to complete commissioning of Unit 6, with planned completion being December 2023. This activity is being paid on a cost reimbursable basis. The closing out of all contract documentation is expected to be completed by February 2024. Contract price adjustment and unresolved variations are the only items remaining to be concluded in the final measure. The unresolved variations have now been included in Claim 5. We are currently reconciling and checking the contract price adjustment calculations, which was paid over the duration of the contract. The final account is expected to be agreed and signed off by the end of December 2023. It is anticipated that the outcome of the measurement process will largely be in line with amounts previously received. All contractor claims giving rise to entitlement for extension of time plus costs, which occurred before 31st December 2019, are considered to be Claim 5. SSBR and Eskom continue to participate in the claims resolution process, which involves independent experts in support of the Dispute Adjudication Board DAB to evaluate the causes of delays and the quantification thereof. On the 11th September 2023, SSBR submitted its revised Claim 5 to the DAB, experts and Eskom, consisting of contractor site-wide and sectional claim of 1.344 billion and damages and finance cost claim of 270 million. The value of the claim increased by 474 million from the previously submitted 1.14 billion to 1.614 billion. The claim is based on the delay analysis as calculated by SSBR's delay expert and will be adjusted once the delay analysis is complete and agreed. Interest is not included in the current claim and will only be calculated once the contractor's entitlement has been quantified. The Phase 1 and 2 delay analysis has been concluded as previously reported, with a total extension of time of 45,000 days for access and 25,000 days for construction delays. The experts are in the final process of agreeing Phase 3 commissioning with the DAB, which we trust will be concluded within the financial year. The original contract duration was 6 years with a completion date of November 2016 and a total planned construction duration of 19,000 days for the 77 sections. Following the conclusion of Phase 3, a final delay expert report will be drafted by the experts and issued by the DAB as an interim decision. The quantum experts and DAB are continuing to meet on various matters related to quantum principles. The frequency and duration of the meetings have increased now that the matters in dispute have mostly been defined. We are confident that the experts, with the guidance of the DAB, can arrive at a final financial outcome during the first quarter of the new financial year. This final outcome will then be published by the DAB as a ruling in terms of the contract. On conclusion of the process, either party may issue a notice of dissatisfaction with the ruling and refer the dispute to arbitration. However, such a ruling will remain enforceable unless overturned in arbitration. All contractor claims giving rise to entitlement for extension of time plus costs, which occurred after December 2019, are considered to be Claim 6. There is an element of overlap between certain Claim 5 events, the effects of which have an impact on the critical path with respect to Claim 6's period. Therefore, Claim 6 will be dealt with once a Claim 5 entitlement has been resolved. These same quantum principles relating to Claim 5 will be applied to Claim 6. On final award from the DAB, the entitlements that will emanate from Claims 5 and 6 will then be recognized in the financial statements. Stefanutti Stocks Izazi Joint Venture, Package 28, Update. In June 2018, the JV instituted adjudication proceedings with respect to numerous compensation events which had not been assessed by the engineer. In February 2019, the contract was terminated by Eskom due to their inability to provide access to the JV for it to complete the works. In August 2019 and April 2020 respectively, the engineer issued 2 negative final payment certificates alleging overpayments. The alleged overpayments were for measured work and compensation events. This prompted the notification of many new disputes, which were then included in the adjudication process. Adjudication hearings were conducted during November 2020 and February 2021. As several disputes relate to measurement of the works, the JV and Eskom have embarked on an independent quantum expert process to resolve these disputes. In order to accommodate this independent expert process, the parties agreed to stay the adjudication process and requested the adjudicator not to publish his decision. Remeasurement of the measured works is complete and a final value for work done has now been agreed. To resolve the alleged overpayment of compensation events, a further agreement was signed. The remeasurement of compensation events is complete and the parties have now started final engagements to resolve the remaining matters. This engagement process is expected to be completed before the end of the calendar year, following which the adjudicator will be instructed to publish his decision. It is anticipated to have all outstanding matters resolved and agreed within this financial year. The group is confident that the final payment application is accurate and therefore no provision for overpayment has been made. Operational overview. One identified operation remains held for sale. Consequently, the results for this period and the comparative period have been prepared to reflect continuing and discontinued operations. The group continues to deliver satisfactory performance. However, the results were affected by the termination of a significant mechanical contract in the inland region, the late award and contract startup of a major building contract in the coastal region, and a reduction in operating margin due to an increase of building contracts executed in the Africa region. I shall now cover the key indicators for continuing operations. Contract revenue of 3.3 billion is 16.2% higher than the comparative period. The group's order book at September 2023 was 6.5 billion, an improvement against 6.3 billion for the prior period. The group is pleased to report a solid operating profit of 69 million, a 27% improvement against a comparative period with no material loss-making contracts. Cash on hand improved with 126 million from 561 million to 687 million. The other financial indicators will be covered later in the presentation by Yolanda. The group prides itself on its health and safety performance. Management and staff remain committed to our health, safety and environmental policies and procedures and together strive to constantly improve the group's health, safety and environmental performances. At August 2023, the group's lost time injury frequency rate was 0.08 and recordable case rate was 0.37. The group continues to be a level 1 broad-based black economic empowerment contributor measured against the criteria of the construction sector charter with a black economic interest score of 70.49%. Although current liabilities have exceeded current assets for the past 5 reporting periods, the group has been able to successfully complete contracts to the value of 37 billion. Thanks to the continued support of the lenders, our operations are not hampered by working capital constraints. The lenders continue to provide guarantee support for current and future projects. Excluding the funding loan, current assets exceed current liabilities by 27 million. The group has completed its internal restructuring, with the Africa region, including Mauritius, as a new territory. I shall now take you through the financial performance of the group's 4 operational regions. Inland regions contract revenue and operating profit increased to 1.5 billion from 1 billion, and to 74 million from 37 million respectively. All disciplines are performing to expectation, with the exception of the mechanical discipline, which was impacted by the termination of a significant contract. With respect to a contract mining project termination, a settlement agreement was signed on 27th of June 2023. In terms thereof, the group will receive 20 million and 10 million by the end of February and April 2024 respectively. This matter is now closed. The arbitration matter relating to the cancellation of a petrochemical contract had to be postponed due to a fundamental change in the client's defence. A date for the arbitration is yet to be set. At this stage, the financial impact thereof cannot be quantified. Coastal regions contract revenue from operations reduced slightly to 544 million, with an operating profit of 268,000, compared against 650 million and 1.3 million respectively. The results for this region were negatively impacted by both late awards and commencement of projects, resulting in deferred revenue and holding costs. Western Cape region's contract revenue increased to 508 million, compared against 306 million, with operating profit remaining flat at 15 million. The disciplines within this region are performing to expectation. Africa region's contract revenue declined to 817 million against 875 million, with a reduced operating profit of 29 million compared against 60 million. The reduction in operating profit is due to the majority of the revenue being generated from building-centric contracts, compared against a general contracting environment in the prior period. All operations performed to expectation. With respect to the arbitration award in Zambia, the award has subsequently been registered with the court. The client has submitted leave to appeal against the judgment. However, discussions with the client have commenced with respect to an amicable settlement. The settlement discussions are on a without prejudice basis, and all legal rights are reserved. Due to the uncertainty relating to the timing and quantum of receipts, the award has not been recognized in the financial statements. Inland regions order book at September was 2.7 billion, compared against 3.3 billion in the prior period. This reduction was mainly due to the termination of the mechanical contract. In the short term, there are potential awards of 1.8 billion and future opportunities of 14 billion. Coastal regions order book at September was 2 billion, compared against 1.4 billion in the prior period. In the short term, there are potential awards of 818 million and future opportunities of 13 billion. Western Cape's order book at September was 911 million, compared against 838 million in the prior period. In the short term, there are potential awards of 2 billion and future opportunities of 22 billion. Africa region's order book at September was 892 million, compared against 851 million in the prior period. In the short term, there are potential awards of 1.8 billion and future opportunities of 31 billion. The group's order book at September was 6.5 billion, compared against 6.3 billion in the prior period. In the short term, there are potential awards of 6.4 billion and future opportunities of 80 billion. Guidance for continuing operations for the next 6 months. Inland region, we expect contract revenue to be similar, with a slight reduction in operating profit margin. Coastal region, we expect an increase in contract revenue and a significant increase in operating profit. Western Cape region, we expect contract revenue to be similar, with a slight reduction in operating profit margin. Africa region, we expect a reduction in contract revenue with a similar operating profit margin. For head office, we expect similar costs as currently reported. I would now like to hand over to Yolanda.
Thank you, Russell. The group reports improved results in a challenging environment, impacted by late contract awards and commencement of projects. In line with the restructuring plan, the disposal of certain operations have been classified as discontinued operations. These disposals are expected to be concluded within the next 12 months. Going concern. The directors consider it appropriate that the group's results for the period be prepared on a going concern basis, taking the following into consideration. The current order book. Imminent project awards. Continuing operations executing the group's order book profitably. The availability of short, medium and long-term projects. Reaching a favourable outcome on contractual claims and compensation events on the Kusile Power project. Continued support from the lenders and a successful completion of current negotiations with the lenders relating to the extension of the loan and capital repayments to June 2025. And successfully implementing the restructuring plan. The funding provided by the lenders has assisted in relieving the group's liquidity pressures, even though total liabilities continue to exceed total assets at 31st August 2023, representing technical insolvency. The group believes it remains commercially solvent based on the cash flow projections included in the restructuring plan and the continued support provided by the lenders. However, the matters as noted above, including uncertainties surrounding the contingent liabilities, as stated in Note 26 of the group's consolidated annual financial statements for the year ended 28 February 2023, continue to indicate that a material uncertainty exists that may cast doubt on the group's ability to continue as a going concern, and as a consequence, could impact on the group's ability to realize its assets and discharge its liabilities in the ordinary course of business. Restructuring plan update. The group is currently in negotiations with the lenders to extend the capital repayment profile of the loan as well as its duration to June 2025 due to further delays beyond the group's control in resolving a number of contractual claims and compensation events on the Kusile Power project and the delay with respect to the disposal of the Mozambican entity. The lenders had initially provided the group with funding of 1.2 billion. With respect to the mechanical project termination arbitration award and the disposal of Altair stocks, a total of 106 million and 59 million respectively has been received. The final purchase consideration still to be collected relating to the disposal of Altair stocks amounts to approximately 29 million. Capital repayments of 51 million and 43 million were made in May and October 2023 respectively, reducing the loan to 1066 million. Interest on the loan is serviced on a monthly basis. The lenders continue to provide guarantee support for current and future projects undertaken by the group. The group will continue to update shareholders on the progress on the various aspects of the restructuring plan. Looking at the statement of profit or loss. With respect to continuing operations, contract revenue increased by 16% from 2.9 billion to 3.3 billion, of which the inland region contributed 1.5 billion. EBITDA increased with 31% from 74 million to 97 million due to improved operating performance and a reduction in restructuring costs. The operating profit for continuing operations is 69 million with an operating profit margin of 2.1%, compared to an operating profit of 54 million and an operating profit margin of 1.9% for the prior comparative period. Depreciation included within operating profit increased from 20 million to 28 million due to capital expenditure incurred in the prior year. Investment income increased to 17 million due to improved cash balances for the period. The increased prime lending rate over the period and comparative period is approximately 3%, which resulted in an increase to interest paid of 79 million. Interest paid on the funding loan is 69 million compared to 53 million of the prior period. The tax charge has been impacted by the profitability of the cross-border operations at their varying tax rates. The group has not provided for a deferred tax asset on the losses pertaining to the South African trading entity. Loss for the period from continuing operations has reduced to 6 million from 54 million of the comparative period. With respect to discontinued operations, shareholders approved the disposal of the Mozambican entity on 22 November 2022. The completion of the transaction is subject to the fulfillment or waiver of certain conditions precedent, of which one still remains outstanding. The discontinued operations reported a profit of 4 million, which includes a reversal of a fair value adjustment of 28 million. The group reports a loss for total operations of 2 million compared to the profit of 9 million for the period to August 2022. The prior year's results included a realization of a foreign exchange gain of 71 million relating to the disposal of Altair stocks. Moving on to the statement of financial position. Trade and other receivables included within non-current assets consists of long-term trade receivables of 9 million after a provision of 25 million was raised in the period, as well as 26 million of cash collateral held as security for certain long-term bank guarantees. Contracts in progress increased by 68 million to 598 million as a result of the increased trading activity. Trade receivables decreased with 6% from 1.3 billion to 1.2 billion, improving the debtors days from 77 to 65 days. Non-current assets held for sale and disposal groups of 1.1 billion predominantly comprises the assets relating to the Mozambique operation. Moving to the liability side of the statement of financial position. Capital repayments of 68 million were made during the period, reducing total interest-bearing liabilities to 1.3 billion. The group envisages to service the funding loan from the proceeds of the Mozambique sale transaction, the sale of non-core assets, and the favorable outcome from the processes relating to the contractual claims and compensation events on certain projects. Creditors' days increased from 30 to 34 days due to the increased trading activity, resulting in trade and other payables increasing to 1.4 billion. Excess billings over work done reduced by 96 million due to the unwinding of advance payments received on certain contracts. Contracting provisions increased with 98 million in line with the increase in trading activity. Liabilities associated with disposal groups amounts to 820 million. Moving on to the statement of cash flows. The cash flow statement is presented for total operations. The operating profit, together with the increase in trade and other payables, provisions and contracts in progress, and a reduction in trade and other receivables and excess billings over work done, contributed to cash generated from operations, including working capital of 184 million. Total tax paid mainly comprises of 14 million of foreign taxes relating to Eswatini and Zambia, and 13 million of withholding taxes. Included within investing activities are proceeds received for the disposal of property, plant and equipment to the value of 25 million, and the receipt of 16 million relating to the Altair stock sale transaction. As mentioned previously, capital repayments of 68 million was made during the period. The group's overall cash position increased to 687 million from 561 million. In conclusion, from my side, focusing on reaching a favorable outcome on contractual claims and compensation events on the Kusile Power project remains a priority. I will now hand back to Russell to close this presentation.
Thank you, Yolanda. I will now cover industry-related matters. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums throughout South Africa. There continues to be a lack of public sector infrastructure spend in South Africa. Should this improve, it will benefit the group. In May, I referred to the Employment Equity Amendment Bill that was out for comment, which intended to give the Labour Minister the power to set employment equity targets per industry. I further highlighted the risk attached to this amendment, being that the targets will be set without meaningful consultation or supported by scientific data. Objections to certain provisions of the bill were submitted to the Minister by the construction sector. A further 14 out of the 18 economic sectors objected to the bill. The bill has since been assented to, but not yet promulgated, as the regulations are being revisited based on the feedback and objections by the different economic sectors on the ministerial targets. We expect these regulations will be republished and a last round of public submissions called for before the finalization of the regulations and the promulgation of the Act. In conclusion, our focus is on the successful completion of all outstanding items in our restructuring plan, achieving favorable outcomes from claims and compensation events on the Kusile Power project, the closing out of legacy arbitration matters, and continuing with our focus on maintaining and increasing profitability. This brings us to the end of our presentation. We are now available to respond to any questions. Thank you.